I mean, Tim, looking at the big four banks, what are your thoughts?
Well, it's something that we've looked at quite a lot in recent times. The big four banks have had a tremendous run. I think the banks as a group are up something like 34% over the last 12 months, which is well in excess of what the broader index has done. In terms of valuation, I think the banks started that 12-month period looking reasonably cheap. After a 34% average growth in share price, they're no longer looking cheap, they're looking a little bit stretched. And I guess the concern from here is what is the extent to which earnings growth can support and sustain higher share prices going forward. We think mid to high single digits is probably the best we can expect for the foreseeable future. So I think we need to expect that returns going forward won't be as good as they have been over the last 12 months.
Okay, so would you be buying at these levels, Tim?
At these levels, I'd be holding, and I think I'd probably be a little bit selective amongst the banks. It's easy to view them as a group, but there are some important differences between them. And I think in particular ANZ is probably one that I would favour at the moment for a couple of reasons. I think the Asian strategy is working and that they're getting some quite good returns from their Asian business. And I think as well ANZ being stronger in institutional banking has the potential to benefit a little more than the other banks, particularly when quantitative easing tapers and we see some more favourable dynamics in terms of interest rates.
And Alan, welcome to the program. What's your question tonight?
Good evening, Julia and gentlemen. Question concerning Flexigroup, FXL. Tim's and Nick's comments, please. And if time, where do you think Telstra's share price is going?
Okay, let's start off with Flexigroup. FXL is the stock code, and we'll try and get the stock price chart. A bit of volatility in terms of Flexigroup share price, but I guess if we have a look at what its business is, it's almost like a mini finance group. It does look at financing for different products, and it's involved in both Australia as well as New Zealand. Tim, just looking at Flexigroup, what's your thoughts on this one?
We like Flexigroup a lot, Alan. It's one that we've owned in the Montgomery fund for some time, and it's one that has over a number of years performed very well in terms of earnings growth and share price growth as well. We think Flexigroup has really good economics. It earns a really good return on the equity that it invests. We think it's very well managed as well. There's a number of parts to Flexigroup, but all parts of that business seem to be doing reasonably well and showing reasonable growth. In what is a difficult market for a company that essentially is providing finance to retail purchasers. In terms of valuation, it looks to me like it's fair value or perhaps a little bit cheaper than fair value, so I'd be very comfortable with Flexigroup. And another point to make is that it's a very predictable business. Management comes out each year with guidance, and they've got a very good record of meeting or exceeding that guidance, and it's the sort of business where you can be pretty confident that you won't get a nasty shock in the foreseeable future.
Okay, so Tim, with Flexigroup, it sounds like they're affiliated with a number of retailers like Super Retail Group, and they've just signed up with Dick Smith as well. So are you watching things like consumer confidence, consumer spending habits when it comes to something like this?
It does have a bearing. That they don't suffer in the same way that the consumer electronics retailers suffer when there's a market, a weak market as we've seen in recent years, because they don't feel the same margin compression and the same pressure on their pricing. So while a healthy growth in consumer spending, and particularly in consumer electronics where they've traditionally been very strong, is good for the business, they're not overly reliant on it. So it's not something that we think has a huge effect on their performance.
And on the line from Queanbeyan, Brian, welcome. What's your question tonight?
Good evening, Julia. Good evening, panel.
Hi.
I would like your comment about Grange Resources, please. It's currently trending up since October.
Absolutely. I mean, iron ore stocks have done very well since iron ore prices bottomed in around about July this year. In fact, in the month of November, the top 3 stocks in the ASX 200, all iron ore stocks. We've got Mount Gibson, Atlas Irons in there as well as Arium. And we've just got a stock price chart there. You can see that prices for Grange Resources seem to bottom in the second quarter, just under that 15-cent mark. Since then, we've seen the stock price more closer to that 25-cent mark. Nice looking chart. Tim, I mean, we've seen iron ore prices really holding up above 135 US a tonne, something that a lot of people weren't forecasting this time of year. It is coming into winter in China, and this does tend to be a time when things do slow down because it's so cold. The steelmakers take a bit of a break as well and slow down as well. But the price of iron ore seems to keep on going. What do you think?
Yeah, we have seen the iron ore price holding up very well, and I think most people expect that the tremendous additional supply that's coming onto the market is likely to drive down the iron ore price over time. But at the end of the day, it's enormously difficult to forecast iron ore prices. It's very hard to know what Chinese demand might be, even though we can see a strong supply response. So, I mean, for us, the issue is that it's really hard to value a business like this. I'm not familiar with Grange Resources. It's not one that's brought itself to our attention in terms of the analysis that we do. But I can see that it's got a pretty patchy history of performance, which makes me think it's probably a reasonably high-cost performer. High-cost miner, rather. What that means is that if the iron ore price does fall in the way that a lot of analysts expect it to, this business may quickly become unprofitable. And so there's a tremendous amount of risk attached to an investment in something like this. The valuation that I can see doesn't make me think that that's a risk worth taking. So this is a good example of the sort of business that we tend to avoid.
And we've got Brett on the line from Sydney. Brett, welcome to the show. What's your question tonight?
Oh, hi, Julia. Mine's regarding OzForex. It reported well recently, and I see the company's got a lot of room for organic growth, especially overseas. And I'm just wondering what the experts thought of it as buying it at these levels.
Sure, so having a look at OzForex, it recently listed on the market. The IPO price was $2, so it has been doing well. It's at $2.92 at the moment. It's also come out with its half-year numbers, and if we have a look at the half-year numbers, coming in at $9.7 million for a net profit. That's compared to $8.4 million a year ago, and OzForex saying it's on track to meet its 2014 prospectus forecast. So, Tim? Do you like this one? Yeah,
it's a good business. I think it's one that we had a look at in the context of its IPO, and it looks like a very attractive business. I think, though, that at the current price, it's quite hard to see value in this one. I note that brokers are expecting very strong growth after 2014. I think it's probably hard to have a high level of confidence that the growth that the business can achieve will accelerate to the extent that brokers are projecting. And so it seems to us that it's a case of a business where there's too much expected of it in terms of the way the market has priced it. So it's not one that we're attracted to at the moment, but having said that, it is a good business.
Philip, welcome to the show. What's your question tonight for our panel?
Oh, thank you. Yes, I'm enjoying Sydney at the moment. I'm down here. So, I thought I'd just give you a call. I sold out of ASX about a month ago and having second thoughts whether I should actually get back into ASX or should I maybe get into Computershare or Macquarie.
Okay, so we've got the ASX versus Computershare versus Macquarie. So let's start by talking about the ASX, and I might come back to you a little bit later, Nick, just to address the first part of that initial question that came through from Eric. Let's start with the ASX. Thoughts on ASX, Tim?
Okay, so I think we've got one caller perhaps asking about the market broadly and one asking about ASX, the exchange as a listed business. Let me maybe tackle the ASX as a listed business. It's the sort of business that seems like it should be a wonderful business. Quasi sort of monopoly, although competition is becoming increasingly an issue. The problem with ASX is that it's quite hard to see how it grows from here, given its market position. And if you look at the valuation for ASX, it does need some better growth than it has achieved historically to justify the current share price. So it's not one that we're attracted to on valuation grounds. Computershare, some similar drivers there in the market activity, M&A, IPO, market activity generally is a driver of CPU's earnings. But again, I think running into some issues as to growth. CPU has done really well growing globally through a strategy of acquisition. I think it's now pretty much run out of opportunities to pursue that strategy, and it needs to take on more challenging growth initiatives from here, getting into developing markets. So to us at the moment, it doesn't look like especially good value. Macquarie, I got a briefing on Macquarie today from the good people at Deutsche Bank, and I think that is a business that potentially has some growth ahead of it in terms of funds management income and performance fees. Certainly, it's probably, of the three, it would be the one I would pay the most attention to at the moment.
We have Tim on the line from Melbourne, so let's go straight to our next caller. Welcome to the program, Tim. What's your question for our panel tonight?
Good evening, Julia. Question is ICAR Asia, similar to car sales in Australia, so I'm just wondering if Tim and Nick have got a view on that internet Asian-facing company.
Sure. So having a look at ICAR, the stock code is ICQ, similar to car sales but dealing in Asia. So I think it's in Malaysia, Singapore as well as Indonesia. The stock price though has been doing extremely well, up 340% over the last 12 months.
From a fundamental point of view, it's hard to put a value on this one. It's yet to earn any material revenue, and it's still loss-making. It's, as we've noted, trying to, I guess, replicate the car sales position in Australia, which, if you can do it, is a wonderfully successful position to achieve. It is something of a winner-take-all market, though, typically, and there's room for one very successful player, and the others struggle because the market leader has the benefit of network effects. I think ICAR Asia, it's probably a little bit binary. It will either do very, very well, or it will succumb to swifter competitors. And I think the key to this one is understanding whether they are likely to be the market leader, and how they are placed in terms of traffic and income versus the other players in the markets they're competing in. Unfortunately, I don't have enough insight to answer that.
Okay, so phenomenal performance so far, 340% over the last 12 months. Nick saying it is due for a bit of consolidation, but not to worry from a technical viewpoint. Let's go to our next caller, probably our last caller of the night. We've got Michael on the line from Sydney. Michael, welcome to the show. What's your question tonight?
Hi, thanks for taking my call.
You're welcome.
The question is about Amcor, the possible demerger, with Amcor concentrating on the rigid plastics and the flexible packaging, and the spin-off, I think, Aurora concentrating on the fibre packaging and the North American distribution. I was just wondering if that demerger goes ahead. I think if it does, there'll be some volatility. Would there be, an opportunity to buy into those companies at quite a low price?
Okay, so a question around Amcor and the demerger, whether that represents a buying opportunity. And we might go to Tim first. I mean, traditionally these demergers have been quite good in terms of creating value for shareholders. Is that going to be the case with Amcor, or are we going to see the stock price up?
Look, it is possible, and I think what you're referring to, Julia, is a phenomenon whereby the demerged entity can represent very good buying for a period of time. Often what happens is that it's too small a business for the investors in the parent entity to retain a holding, and so as soon as it's demerged, they all sell it off, and it's quite good value. I'm hoping to attend a briefing on this one soon to better understand it, but from what I'm told, the Amcor share register has a lot of very big institutional holders who may be unlikely to hold the spin-off, and so depending on where it trades, there may well be an opportunity to buy the child entity at a very good price, but I don't have enough information on it yet, and obviously we don't know the trading price for it yet.